They understand this information and you don't, you're at an intellectual disadvantage.
Well, the demand for my attention just went up.
Well, that's what I was trying to do.
Yeah, but the supply though is just...
Previously on Commercially Speaking.
I'm excited. What are you teaching me?
Today we're going to talk about market cycles. Demand, especially in real estate, demand is driven by people. In commercial real estate, supply lags demand. I mean, it can take years to create the supply to meet the demand, and because of that, it causes these market cycles. I'm going to show you Dr. Mueller's model. You've essentially got 4 quadrants. You have recovery, expansion, hypersupply, and recession. That dividing line horizontally is the long-term occupancy of that market. This point number 11 has this vertical line here. Point number 11 is equilibrium, and this is the magical moment where supply meets demand. If you have more demand than you have supply, you're on the left side. You're either in phase 1 or phase 2. If you have more supply than you have demand, you're in either hypersupply or recession. So this is how this is broken out into the quadrants. Phase 1 of the market cycle, this is the recovery phase. Demand is starting to increase, but it hasn't increased enough to drive rents up enough to where it makes sense to build any new supply. Your occupancy rate is building up to the point where you have reached the long-term occupancy average for whatever market you're in. Mm-hmm. Once that happens, that starts phase 2 of expansion. At point 8, rents have risen enough to where it is now profitable to build new supply. And as these developers start delivering their new supply to the market, well, you'll get to 11. You've reached equilibrium. But the market, in my opinion, stays there for about this long. What happens is, and this happens every time in every market cycle, developers always overbuild. But people still have to finish these projects, which just continues to provide more supply. Your occupancy rates are starting to fall back down to that long-term average. And there's still new construction happening. They'll finish those projects all the way into phase 4 recession. And it gets down to that point 1. That point 1 is the same in phase 4 as it is in phase 1. That's the bottom of the market. So yeah, if you understand where you are, you might be able to get in front of everybody else. When you hit point 1 at the very end of recession, that's also the very beginning point of recovery. And there are all kinds of people in the commercial real estate industry right now that got in after 2010, 2011. And if that's true of you listening right now, and this is your first down market, you really need to hear this. There's always a recovery after. Think about this. If you're at point 1, 2, and 3, and you're a tenant, all right, and you're wanting to lease space, okay, your business is doing fine, but you're at 1, 2, 3, so there's more vacancy in the market than normal, okay? Rents are generally down a little bit at this point, and you wanted to lease space, and you're at 1, 2, and 3, somewhere in that recovery phase. Would it be more beneficial for you to sign a short-term lease right there or a long-term lease?
Listen, you'd want to do a short-term lease because a long-term lease because the rents are going to be down, right? Because
that's exactly right.
Yeah.
If you're a tenant, you can lock in your lease term at the bottom of a market. That's generally advantageous for you, okay? Now, on the flip side, if you're a landlord, and this is something I did throughout COVID, is I had some tenants renewing, and they were willing to take the risk of higher future rents because they wanted the flexibility. That was fine with me. When we get to the top of the market as a landlord, that's where I want to lock in my tenants to long-term leases. I want to lock them in at the top. If they understand where they are in the market cycle, that's where they would want to do shorter-term leases. Mm-hmm. So even in this just process of leasing space, whether you're the landlord or the tenant or the broker serving one or the other, it's very important that you understand where you are in the market cycle so that you can advise your clients. But what other questions do you have?
When can we start the pop quiz, baby?
Yeah, okay. I want to quickly run through what this market cycle monitor is what he calls it, okay? At the beginning, I just want you to understand what's in here because anybody listening to this can go to this website and download this. It's there available for you. And so you can see where things are. And so, first page, he gives an overall quick summary. Office occupancy declined by 3.3% in the first quarter. I'm not going to read all this, but it gives you all that. Their rents are up 1% annually in office nationwide. Okay. And this is covering 54 of the largest metropolitan statistical areas in the country. Okay.
Okay.
And then on this first page, he tells you where each sector is. So
Oh.
look at apartments. Nationally, apartments are at 0.13. What sector is that?
Phase 3.
And they're in hypersupply. So we would be expecting that the occupancy rates of apartments nationally have been above their long-term average, but are falling back towards that average right now.
Mm-hmm. And that's probably why there's such a need for low-income housing and low-income
That's a little bit of a different issue, but yes.
I mean, it's like all developers had the money, and it looked like there was the demand for, people with a higher income, right?
Mm-hmm.
So nobody was focused on low income because the expansion was happening.
That's right. And the apartment right here, this is talking about market rate apartments.
Right.
Now, if you look at industrial, R&D flex, industrial warehouse, they're at 0.11 nationally of equilibrium. There's about as much demand as there is supply. So occupancy is very high. Rents have been increasing substantially year over year for a number of years now, and they're at 11. So this just gives you a feel for where each sector, downtown office is at 4, office, suburban office is at 16. Just this nasty point of recession kind of at the bottom. So he gives you just a picture overall of the United States and where each sector is. And then what he does is he explains his model. This is sort of what we were talking through earlier with the points. He gives some a little bit more data here, and then he breaks it down by office. And what he does here is really cool. Here's office, and he has the top 50 or so markets and where they are individually. So, if you go back and you say, okay, office is at 4, downtown, CBD office at 4, suburban's at 16. But if you break it out by market, where are they? And that's what this says. So Chicago's at 2. Palm Beach and Riverside, they're at equilibrium. Like their office market is nice. Memphis, Nashville, they're over here in hypersupply. Right? So you can see how this by market really makes a difference where you are. All right. It says the nation is right here at 4. Now see that -1 after nation?
Yeah.
That means that the previous quarter's report had them at 5. The nation was at 5, and it moved back to 4.
Gotcha.
So you don't always have a situation where things go from one number to the next sequentially. Sometimes they can go backwards if something happens. They knock them back. Right?
Gotcha.
You'll also see +1s. Here's +1. Orange County was at 1. Last time it was at 16. All right. See, Boston was -3. It moved back 3 spots. So did San Antonio over here. Minneapolis moved forward 4 spots. So the numbers after tell you how it moved since the last report. Okay. And then he breaks out office. Here's industrial. Pretty much the entire country is at equilibrium. And there are a few markets that are into hypersupply. But industrial has been really, really good, really hot. Lots of new supply, lots of new demand, lots of higher rents for a long time, years. And so it makes sense that we're at an equilibrium and bouncing over into hypersupply in some markets. Apartments, same deal. If you looked at this about a year ago, the whole country, I think, was at equilibrium at 11. And now you got Chicago, LA, New York. They're all at equilibrium, but most of the country now is into hypersupply, and you've got a few that are down here into recession. Okay. Now, you may notice some of these markets are bold. See how they have bold lettering?
Yeah.
Those are the largest, 1, 2, 6. The largest 10 markets get bold. All right. And that's basically the report. And at the end, he kind of gives you an explanation on how all this works, which probably explains it all better than I tried to today. But that's what the Market Cycle Monitor is. It's available to anybody who wants to go get it. That information is there for you, and it gives the commercial real estate decision maker a data point that can be very valuable in helping them make wise decisions about the future.
All right, I've got a question.
Yep.
When you say that it goes back, right? Sometimes it can go back a number or whatever.
How does that happen?
No. I think I understand how it happens, but if we're looking at the cycle, right, you assume that it just keeps going along in a linear fashion. Yeah, so if it goes back, it's probably just short term. You can't expect that it's going to keep moving backwards on that. You're just like, oh, it moved back a little bit, but it's probably going to.
Yeah. So think of it this way. And this just popped in my mind. So I hope this analogy is a good one.
Yeah.
But a river flows in one direction, and it always flows in that direction. Unless you live in Chicago, and at one point back in time, they reversed the flow of the Chicago River. I still don't understand how they do that. I'd love to see a documentary on that. That's incredibly interesting. But a river flows in one direction. However, if you were to throw a stick of dynamite and it were to explode underwater, for a brief moment, it would be pushing some of that water back the other direction. So sometimes you can knock a product type or a particular market back a few. But to your point, I would say that there's generally some kind of event that happened to cause that change in direction, and it would also be fairly short-lived.
Yeah, gotcha. You know what? I think they used dynamite on the Chicago River.
Is that right?
Well, I'm just looking it up. By constructing the 28-mile-long Chicago Sanitary and Ship Canal, this project, the most ambitious example of civil engineering of its time, took 8 years and the removal of 42 million cubic yards of soil and rock.
Wow.
It didn't mention TNT, but I imagine that's how you would do it, right?
I guess.
Alexa, play
Man,
TNT by AC/DC.
Here's TNT by AC/DC on Amazon Music.
I.
Okay. Yep.
Alexa, stop. Okay, cool. I can
All
move
right.
on now.
You ready for a pop quiz?
Yeah!
All right, pop quiz.
Is it fun to
All
hear
right.
me in the other room?
Yeah, it is. I get to hear it twice. Yep.
Yeah.
Okay, so question number 1. What's the main reason that we have a market cycle?
Because supply lags demand.
That's exactly right. Supply lags demand. Very good.
Yeah, baby.
All right. Question 2. Describe for me the 4 sectors of the market cycle in Dr. Mueller's model. Name them in order.
Okay. Number 1, recovery.
Yes.
Number 2, expansion.
Yep.
Number 3, hypersupply. Number 4, recession.
That's exactly right.
Yeah, baby. Yeah, baby.
Oops. Just punched my microphone.
I went into chicken for some reason. My excitement came out as a chicken. Yeah.
Okay, true or false? Is the position of, say, office in the market cycle uniform throughout the country?
No, it's not. No, it's very different in the different markets.
Why?
It's because of the hyper-local nature
Nature of demand.
real estate.
Yeah.
Yeah.
Yeah. The markets with job growth, especially aggressive job growth, are going to have generally basic jobs that have an economic base multiplier that throw off non-basic jobs. Those people have families. So use the population employment ratio to figure out actual population growth, and that drives demand for all sites. People use space. So the more jobs there are in a market, the more demand you're going to have for more space, which means the more developers are going to be needing to build supply to meet that demand, and there's that lag, right? Question number 4, what, and you got to ask this question with a big smile on your face, what happens at the end of every down market?
An up market, baby.
That's exactly right, baby. Exactly right.
Recovery. Yeah.
All right, question number 5. If you're a landlord and the market for your property type that you own is at, say, 0.2 in recovery, phase 1 recovery, all right, point number 2 on Dr. Mueller's model, should you be signing your tenants to long-term or short-term leases?
Short term.
So you're the landlord, you want to do short-term leases at the bottom. Why?
Because the rents are lower at that time, right? You can expect that the rents are going to go up. You know, you don't know exactly when, but according to the cycle, they're going to go up. So it's better to have short term so that when it comes time to renew, you can hit them at the market, assuming the market will be higher at the end of that short term cycle.
That is exactly right. And you know what this means? 5 for 5, my brother.
Yeah, baby.
It means that you understand market cycles.
Yeah.
This market cycles to me or understanding them, learning about them, felt like physics did my senior year in high school. I went into physics not wondering, I was wondering actually, am I going to like this class or not? And I ended up loving it because it explained why things work the way they do. You know, I remember studying about how you slant a road on a curve.
Yeah.
Using some centripetal force to keep the car on the road. Why they bank the road at a certain amount on purpose.
Yeah.
Like everything we learned in that class just explained how things worked in the real world, and I loved it. And this market cycle gives me that same feeling, like this explains so much. So thank you, Dr. Mueller, for creating it and sharing it with the world.
We can't wait to hear from you.
Call me.
Call us, Dr. Mueller. Dr. Mueller. We'll tag you on Twitter. I assume maybe he'd be on Twitter, if anything, or LinkedIn. I also loved physics. I learned nothing, but I had my best friends in the class and that teacher, Mr. Zeller. You've heard those stories of Mr. Zeller.
Oh, yeah.
What a class. Woo.
We should do an episode one day that has just a total one-off throwaway episode where we're just telling our best stories.
Oh, yeah.
Whether they have to do with commercial real estate or not. I think that would just be a pure entertainment, no education necessary. That'd be a fun.
I agree. I also, too, because I pitched this to Dad either this morning or yesterday when, I told you the idea of, hey, let's go into Mom and Dad's screened porch and you, me, and him just set up, have cigars and bourbon, right? And let's just chill, talk. Let's talk about the history of where Barron Commercial Group, the history of it, right? Where it came from. Because once we start talking history and how things develop and stuff, Dad will he'll go, almost like a legacy episode of sorts. And ideally, it'd be awesome to have all the brothers on that particular one, I think. Just for Dad. He loves having cigars and bourbon with his sons.
Actually, if we can get our sisters to have a cigar and drink some bourbon with us as well, he'd
that'd be
love
great.
that even more. But to date,
he would.
We've never really been able to.
But I was thinking about for Cody, because I just can't envision Cody having a cigar or Mange even, just wouldn't want it or be into it.
Maybe they just chew on one without lighting it or something.
They could, 100%. But I was thinking about, because we want to have Cody on too. And of course, we'd love to have Mange on, just fail it. But I think, there's going to be plenty of room and plenty of time to have, a couple one-offs where we get the fam together, get Dad talking about, commercial real estate. But
right.
I love it. Cool. All right. Sweet.
Well, love you, brother.
Love you too, brother. Peace.
Later.
Bye. Bye, Alice.